Welcome to my channel. I'm the Covered Call guy, and this is my journey to creating a $120,000 per year passive income portfolio. My portfolio currently yields almost $70,000 a year, just about $6,000 per month. I'm going to be strictly using Covered Call ETFs to reach my goal, and once I reach my goal, what should I do? Leave me a comment. Let me know. I'm open to all options. Before we get started on today's video, legal disclaimer. This content is for informational and educational purposes only and is not financial advice. I am not a licensed financial advisor or tax professional. All opinions are my own and may be incorrect. Trading and investing involves risk, including loss of principal. Always do your own research and consult a licensed professional before making any financial decisions. I'm just some random idiot you found online, and I could be completely wrong. All right, with that out the way, let's get started on today's video. So today's video was inspired by all of the discussion on X, formerly known as Twitter. I come across these debates a lot on weekly versus monthly cover call ETFs, and why a lot of people think weekly are better, and why some stick strictly to monthly, and why some have majority monthly and a little bit of weekly, or some have majority weekly and some monthly. Today it's going to be a breakdown on which is quote unquote better for the investor of their preference, and why I choose majority monthly and a little bit of weekly. That might change again when I reach my goal. Maybe I'll divest more funds into weekly and start building up a weekly fund. I don't know, but right now we'll deep dive into weekly versus monthly and which will be the best for you. All right, weekly versus monthly cover call ETF. We're gonna do a strategic analysis. All right, defining the instruments. All right, so monthly options, monthlies. These are traditional contracts expiring the third Friday of each month. The strategy: sell 30 to 45 days to expiration. The profile behind this is the sweet spot to balance premiums received against the rate of time decay and risk, right? The risk lower gamma, which is the slower price change. And then weekly options, right? Weeklies, short duration options expiring every Monday, Wednesday, and Friday, right? The strategy behind this is to typically sell 7 to 14 days out of a date of expiration. The profile behind it is the entire goal is to repeatedly capture the most aggressive period of time decay. Higher gamma, which is the volatility price change, right? So it's much more aggressive because the premiums are also much higher. So the more aggressive, the higher the premiums are, but also the higher risk of a higher gamma. Strikes and spread, right? You want it to be liquid because liquid means there's buyers and sellers, right? That's what makes the premiums higher, right? Weeklies require finer strike increments, $1 or 50 cents, because the strike must be very close to the stock price to be worth any premiums, right? Then the strike buffer monthlies have wider increments, $2.50, $5, and so on, but can be sold much further out of the money, OTM, for a worthwhile premium, creating a larger buffer zone. Right, so start thinking about, all right, this kind of the difference between weeklies and monthlies. Where do I fit in? You know, what fits my investing preference, right? And the liquidity myth, the idea that monthlies are always more liquid, is outdated, is not true, right? It is a 100% stock dependent. For example, SPY or Apple weekly or extremely liquid. For a utility or REIT, they can be liquidity deserts with wide costly spreads. So for example, like a single stock like O, or the NEOs, I think it's IYRL or something, right? It's not as liquid because most people don't really trade REITs like that, right? They just buy and hold the REIT. They don't really care for trading real estate. It reflects like actual physical real estate. You don't just buy a house and then sell it the next day or sell it the next week. It's very unlikely. Gross annualized yield. We call this the siren song, right? Weekly strategy, 52 trades at $50. You might get higher versus a monthly strategy of 12 trades at $150, right? This is just an illustrative example. In this model, the weekly strategy generates 44% more gross premium per year. This is the central and often misleading attraction of the strategy. Right? The gross versus net fallacy, right? The higher gross yield from weeklies is deeply misleading. It incorrectly assumes that there's zero losses across 52 consecutive successful trades with no losses. No whipsaws, which is you assume the stock never rallies, forcing a buyback for a loss. Zero costs assumes no transaction costs, commissions, or fees. Fewer points of failure. It ignores that 52 expiration offer a 4.3 times more opportunity for a trade to go wrong than 12. The science of time decay, Theta. Right, the higher the value, right, and then it starts going down over the course of the time, right? The time decay is not linear. It accelerates exponentially in the final 7 to 10 days. Weeklies live on this steep volatile curve, while monthly captures slower, more linear decay. And so obviously slower means a little bit less premiums. The more aggressive, faster means we have to capture that higher payout as soon as possible, right? So this is the theta and gamma paradox. The paradox: you don't manage theta profit, which is automatic. You must manage gamma, which is the risk and price sensitivity, right? So the higher the theta, the higher the gamma. The profit from weeklies is direct compensation for high unstable risk. So now we start diving in which type of investor are you, right? And then we have the management experience, which is the monthly, low gamma, easier to manage. The position is quiet, low stress, and can absorb market noise. It gives you time to be right. Weekly, high gamma, hard to manage. Price swings are wild and high stress. It demands you be right almost immediately. Defining consistent income, right? This is the debate about income stream variance, not just frequency. Weekly equal frequent but volatile income, right? Provides 52 small paychecks with high variance. You might get $50 that month or 45, or you might, or it might drop and your total income might drop $200, and then next month it might increase $60, right? A single loss can wipe out a month of gains. Right, monthly equals stable and predictable income, right? Provides 12 larger paychecks with lower variance, right? This month you get 150, next month you might be down $10, but the next month you make it up by going to 160. This is a far more consistent for budgeting and knowing what you're going to be paid. Gross versus modeled realized yield. So here is just a chart, right? We have the factor, the weekly strategy. Gross annual premium is $2,600, 26% versus the monthly at 18%, and then commission drag with 0.65 cents on a contract. So you see here weekly is possibly going to cost more, right? And then the model whipsaw loss, four bad trades. Weekly you're down 800 versus monthly you might just break even, right? So at the end you can see a monthly performed 0.2% better, which 0.2% I'll take 0.2% more money every time. And this is just an example, right? It's just a plausible scenario. After cost and realized losses, the high yield weekly strategy actually underperforms. And then I put underperform because again it's a model. It's not going to always be 100% correct. Primary risk profiles, right? The monthly strategy risk is the opportunity cost, which the FOMO. This is fear of missing out. The stock gaps up to $120, but your upside is capped at 105. You miss out on $15 of profit, right? This is a logical risk. Versus weekly strategy risk, gamma and whipsaw risk. Stock rallies, call value explodes. You panic buy to close out for a loss. The next day, the stock pulls back. This is realized financial loss from a psychological trap. Assignment and shocks, right? Assignment risk, weeklies, higher probability of finishing in the money because the strike is sold much closer to stock, versus monthly, higher probability of early assignment specifically to capture an upcoming dividend. All right, then we have event shock like earnings. Weeklies, this is a binary gamble. A 20% upside gap after earnings is a huge loss, right? Versus monthly, it's more of a strategy. You're playing a long game. The 30-day buffer absorbs the shock, it captures the post-earning IV crush, and gives the stock time to settle. How to use volatility, right? IV for short. In a high IV environment, pros use weeklies to aggressively capture higher premiums. If you're the expert, right, this is where you have to know what you're doing. You have to know what you're buying. Beginners use monthly to sell strikes very far out the money for a safe premium and master buffer zone. Right? It gives you time to evaluate your strategy. In a low IV environment, weekly, this strategy will suffer. Premiums can be low, maybe 10 cents on a dollar. They are not worth the click, right, after fees. Monthly, this is the bread and butter. The 30-day plus of time value still provides a meaningful premium to sell, right? So you have to understand how these covered calls are operating. When you know how weeklies typically get bought and sold versus monthly getting bought and sold, you can now understand how these covered call operate. Right now, you can kind of understand their strategy. It's not always accurate because big hedge funds do have far more options, such as flex options, which little guys like us will not have. But this is just a crash course on weekly versus monthly, and it gives you an idea on how these cover call kind of operate under the hood. The role, flexibility versus necessity. Weekly is a rolling necessity. Rolling is frequent, high stress, and defensive with no time to buffer. A challenge position must roll immediately to avoid assignment, often to net a debit, which is a loss, just to survive another week. Monthlies, rolling is a strategy. Rolling is infrequent, low stress, and offensive. With 2 to 3 weeks out, you can wait for a pullback. If not, you can strategically roll up and out to a higher strike next month for a large net credit. The commission drag, right? So weekly, 52 trades at 65 cents on a dollar. You might only profit 33 bucks. Versus monthly total trades at 65 cents dollar, you might only profit $8, right? Weeklies have costs. Sorry. Weeklies have 4.3 times more commission drag. This is significant and often overlooked impact on net profitability. So you can see here, monthly has a lower commission drag. The time tax management effort, right? 10 times more active management. If you're gonna go for weekly cover call ETFs, you're the active trader, right? Requires daily or even hourly monitoring. You have to be on your phone from 9:30 to 4 p.m. Eastern time, right? So you are basically that guy or girl that have to monitor their positions on a daily to hourly basis. So you're watching the news, you're on Reddit or X or whatever social media app you use to kind of stay on top of the news, right? For me, this is a very high stress, high time commitment, which is why about 90% of my portfolio is in the monthlies right now. I want to be the passive investor, right? Kind of can be set and forgotten for the first 2 weeks. A low stress, low time commitment, suitable for someone with a full-time job. The tax man, right? So this is a tax man comment. This is the most critical factor for long-time investors in a taxable account. Premiums. All premiums is taxed as a short-term capital gains for both. Again, depending on your covered call ETF and what strategy they use, what tax advantage strategy they have, it might not be taxed at all. How they pay out. This is just a generalization. The real danger is assignment weeklies, high risk, high assignment risk, constantly risk getting your long-term shares called away. This resets your holding period. This single event can turn a future 15% long-term gain into a 35% plus short-term gain, wiping out years of call premium. So you have to look at your weekly call ETF and how the fund managers execute their strategies, right? Monthlies are designed to avoid assignment and preserve favorable long-term capital gains status of your shares. A roadmap for beginners, right? So of course I would always start personally, I will always start with the monthly called ETFs, right? They are a bit more forgiving. They give you a margin for error and time to learn the mechanics without immediate large losses. Low operation load allows you to learn the process, selection, execution, exploration. Obviously, you're not doing this yourself. You are letting the cover call fund managers. That's why you're paid an expense ratio. But if you understand the mechanics on how they choose it, you will be able to better choose the cover call ETF for your portfolio, for your lifestyle, right? So this allow without the high stress of daily monitoring, right? So you know how under the hood of these fund managers execute the strategy. So okay, right, they're doing well. I don't have to worry about whether the market goes up or down, right? I know their strategy. I know they are buying out the money, and it's monthly, so nothing to really worry about, right? It's lower risk, lower cost, lower risk. Prevents you from being churned, all right, burnt out by high commission fees and devastating whipsaw losses. Weeklies or an expert level tool. When you buy weeklies, you really should be understanding how it really operates, right? So if you are new, buying weeklies have destroyed a lot of people in the high yield community because they thought it was easy money paying out weekly, and they got absolutely destroyed. The hybrid pro strategy, right? For experienced investors, segmenting your portfolio gets the best of both worlds. A core position, 70-80% of shares, use monthly calls. This goal is stable income and capital preservation. The primary objective is never to be assigned and protect your long-term capital gain status. And then tactical position, 20-30% of shares, use weekly calls for aggressive premium capture, right? Around the earnings. You are indifferent to assignment as this is a trading position. So like I said, 80 to 9% of my position right now is about all monthly, and just about no more than 20% is my tactical position on my weeklies. Matching profile strategy to profile, right? Profile 1, the passive investor, right? Is this you? Is your goal stable income, low stress, preserve long-term capital gain status, right? Identity, I am the stock owner. That's me. That's what I want to do, right? Strategy, I'll go for the monthly. Or profile 2, are you the active trader? Do you know what you're doing? Do you, you're the, you know what? I'm all in. Casino, baby. It's ride or die. I got a little bit of experience. I feel like I know what I'm doing, right? Goal is to maximize gross yield, active management, indifferent to assignment. Identity, you are the option seller who uses stocks as collateral. That's you, the weeklies. And this is just to help final decision making matrix, and this is how I break it down and how I came to conclusion to how I want to build out my portfolio, right? So the factors of weekly covered calls, higher gross, higher variance, gamma, whipsaw risk is higher, frequent necessary position management, you have to be very defensive. Commission is probably much higher. I believe weeklies, I think weeklies are like 0.99, right? Expense ratio for the most part, which is ridiculously high. It has to be worth the juice. Time commitment very high. Tax efficiency could be very poor, again, depending on your cover call ETFs. And for beginners, absolutely not. Versus monthly cover calls, right? Lower growth, higher consistency. Um, Opportunity cost is much better. I'm not gonna FOMO, and infrequent, and it's infrequent position management. I can just kind of buy, and whatever, if the market goes down, I'll just dollar cost average into it. It's very strategic, and it's much more offensive based. I go on an attack if the market goes down, right? And then commissions, right? Lower cost drag for the most part. It's anywhere from, I think, as low as 0.29, which is the Goldman Sachs GPIX GBIQ, to like the NEOS is 0.68. So there might be some that are a little bit higher, but for the most part they're going to be lower than, fact check me on this, I'm pretty sure most of them are lower than the weekly call ETFs. I should have added this, but okay, all right, you guys can fact check me on that. Anyways, time commitment for the monthly low, right? With the passive investor, tax efficiency good. I would put good for both. Again, it's just obviously, I had to pick, and I just had to show for the video which one would be better. Good, both of them could be good. We won't know for any of this until end of the year. And then for beginners, absolutely, right? It's more forgiving. Part 2, covered call ETFs, right? A new class of products automate the strategy. But strategy and product are not the same. Let's analyze the new 2025 landscape. Right? So the ETF trap, total return versus NAV erosion, right? So total return trumps yield. A 20% yield is meaningless if the ETF price NAV drop 50%. Sorry, 15%. Total NAV plus what is distributed, right? So NAV erosion, what does it mean? High yield ETF, especially daily or weekly refunds, high yield ETF, the weekly and daily, they reset the funds. They capture 100% of the upside, and then in a bull market they capture 100% of the downside, but 0% of the upside, causing the NAV to erode or decay. Right? It's a very misleading yield. This NAV erosion means high distribution. It's often return of capital, your own money back for the not return on capital profit. So I did a video on return of capital, and it could be very misleading. So please watch that video and understand the difference between good rock and bad rock. ETF adjusted performance. So we're using 2025 data, right? The Sharpe ratio, this is the true measure of performance. It calculates your return per unit of risk. A high unstable return is worse than a moderate or stable one, right? So monthly that are active at JEPI and JEPQ, these ETF only write call options on a portion of the portfolio. This allows for some upside capture, which protects the NAV and leads to superior risk-adjusted returns, right? We want to always protect the NAV while capturing consistent payments, right? Then we have the daily, weekly, QQQY, IWMY. These are much more higher yield and higher volatility, with a higher chance of NAV decay, right? Resulting in a lower Sharpe ratio. They are pure income tools and not growth and income tools, right? So you have to pick one or the other for these weeklies. They might not always be growing and paying out, right? So there's a higher chance of it paying out. The NAV is stable for a while, and then it drops. Not all weekly not all weekly cover call ETFs. I just want to put that out there, right? There are some great weekly cover call ETFs. ETF landscape, daily versus weekly versus monthly. There's really no daily right now. I just put that out in case you want to go ahead and do your own cover calls to I guess get your own experience, right? So daily / weekly ETFs, QQQY, go maximize income, right? 0 day to expiration or 1 day expiration on 100% portfolio, right? Pro, extremely high monthly payment. Cons, 0% upside capture, high NAV erosion, lower total return in up markets. Then we have the monthly active, right? Using JEPI just for example, the goal is maximize risk adjusted returns, right? Monthly calls or ELNs only on 50 to 7% of the portfolio. Pros, balance high income with partial upside capture, much better NAV preservation, The con is that the yield is lower, and I put in quotes because it's still pretty high, than daily or weekly ETFs, but the total return is often higher. And the verdict, right? 2024 to 2025 data confirms that monthly covered call ETFs overlays are superior for total return and sustainable risk-adjusted income. And then we just the ETF product matrix here. We just used the QQQY. As I mentioned before in the previous slide, it just maximizes income yield. Upside is fully capped. NAV erosion risk is very high. Is best for pure income in a flat down market. Risk adjusted return lower, and then monthly active ETF JEPI, for example, maximize risk adjusted returns. Upside capture 20 to 50% partial capture. NAV erosion is always moderate. For the most part, covered call ETFs is always going to be moderate, maybe low moderate, but it's always going to be moderate, right? Covered call ETFs are not your typical growth stock. There's always going to be risk with the market completely changing course. Best for a stable income in all market cycles, right? Is very defensive and higher risk adjusted returns. All right, so in quotes, the best all-round ETF strategy. The better strategy is to buy all-round metrics. The leading strategy is actively manage monthly overlays, right? JEPI, JEPQ, for example. Why do they lead? The approach provides the best chance for a balanced high total return, strong yield, high risk adjusted returns, and minimal NAV erosion. I'm very big on NAV erosion. The trade-offs. Other ETFs like the weeklies reset and they excel in isolated metrics like higher gross yield, and that's really all they really put out, right? Yield, but it's misleading because actively managed monthly strategy leads the best rounded choice for investors if both growth and income matters. Final verdict, right? Who are you? Right, you're done watching this video, so who are you? Which one do you want to pick, right? This choice of strategy is not which is better. It's about aligning your goals, risk, and time. For the weeklies, covered call ETFs is a high frequency, higher maintenance, offers higher gross premiums, but at the cost of higher gamma risk, higher costs, and tax inefficiency, which I'll just put out there, we won't know until the end of the year, right? You are the active trader versus a monthly. Maybe you're someone like me, right? You want lower frequency, lower maintenance, a little bit more stable, a little bit more consistent, lower risk, and it's far more tax efficient, which I should have put in quotes. We don't know until the end of the year. And we are more of the passive income investor strategy, right? I just want to be sipping a nice drink on a beach somewhere, not worrying too much. That's the whole goal of income investing, right? Questions, please comment, subscribe, and like. I will do probably a deep dive if you leave a comment. I have no issue with that. That will probably give me more comment or more content. I hope this video was educational for you. Hope you decide if you were on the fence or if you wanted weekly ETFs or monthly ETFs. So hopefully this video has helped. Thank you for watching and stay tuned for the next. Thank you for joining me on my journey.